Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if this company's paperwork is full of hot air or actual plans. Edgemode Incorporated is back with some news, and this time it's about a deal they made that's going to affect how they operate. The main story here is that Edgemode Inc., or the company as they call themselves, has brought in some cash by selling something called an unsecured original issue discount promissory note. Think of this note like a loan, however, it is sold at a discount, making it a bit more complex. They got $250,000 in their pocket, but they owe $287,500 on this note. That extra $37,500 is essentially the company paying extra for the loan upfront, or essentially interest baked into the principal. This money is going to be used for working capital, which means day-to-day expenses like paying bills and employees. As a sort of sweetener for whoever bought this promissory note, Edgemode also handed over a whopping 8.5 million shares of their common stock. This is a pretty significant chunk of shares, and it is important to remember that issuing more stock can dilute the value of existing shares. The buyer also kept back $6,000 for their own legal costs from the price they paid for the note. Now let's talk about the terms of this loan. It's got a 10% interest rate, but if they don't T-pay it back on time, that rate jumps to a very steep 24% per year. Or whatever the legal maximum is, the loan is due in 1 year, on the 15th of September 2026. The really interesting part is that this note can be converted into the company S common stock. The conversion price is set at 65% of the lowest closing price of the company's stock for 10 days before the conversion, or a fixed $0.01 per S share, whichever is more favorable to the investor. This is designed to protect the investor. If the stock price drops, they can convert their note into more shares, and if the stock price stays low, they get a super cheap entry point. Edgemode has also agreed that if they get any significant cash inflow, like from selling assets or other financing, they have to use up to a quarter of that money to pay back this note early. And here is a kicker in the agreement: if they use this cash inflow to pay back the loan before any specific bad things happen, they have to pay back not only the principal and interest, but an extra 10% bonus. That means they would pay 110% of the principal amount, plus 110% of the interest. The agreement also lays out what Edgemode considers a default, like not paying on time, not filing their required reports with the SEC, or not keeping their stock listed on a trading market. If any of these things happen, the entire loan becomes due immediately. There is a cap though. The investor cannot convert their note into shares if it would make them own more than 4.99% of the total outstanding shares of Edgemode. As stock, this is a common clause to prevent an investor from accidentally taking control of the company through a conversion, what they call a beneficial ownership limit. This whole deal was done as a private placement, meaning they did not offer it to the general public and are relying on an exemption from registration requirements. This is typical for these types of deals. The deal is officially with First Fire Global Opportunities Fund, LLC, and the actual documents have been filed as exhibits. Now, looking at this from a higher level, Edgemode is in a situation where they are clearly needing cash for operations. They are raising funds through debt that is convertible into equity, which is a financing strategy that can be a double-edged sword. On one hand, it provides immediate capital. On the other hand, if the stock price is low, the convertible debt can be converted into a large number of shares, significantly diluting existing shareholders. The high penalties for early repayment and the investor-friendly conversion terms suggest that Edgemode might be in a bit of a tough spot financially, or at least needed this funding quite urgently. The conversion price being tied to a percentage of the lowest closing price is a common feature of deep-in-the-money convertible notes, which can put downward pressure on the stock price as the conversion date approaches or as the company continues to struggle. The company's ability to meet its obligations, like timely EC filings, is crucial, and a failure to do so could trigger immediate repayment with penalties. This is a significant risk for the company. Overall, Edgemode appears to be using a financing method that is common for companies that may have limited access to traditional bank loans. It allows them to secure funds, but at a potentially higher cost in the long run due to dilution and interest. The key for investors will be to watch if Edgemode can improve its operational performance and stock value to make the conversion terms less attractive for the note holder, or if this financing simply delays a larger issue. Alright, that is our breakdown of Edgemode's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.